So we were cruising down the interstate at 1 o'clock in the morning on our way from Virginia to Florida. All of a sudden, there it was. Bang! Everything shook. The whole truck was moving around. Our U-Haul was swerving on the road. And the first thing that I did is I veered over. I had to assess the damage, see everything that had happened. When I got out, to my wondering eyes, what appeared to me, our tires had shredded on the back. We were driving on one tire on one side. The other one completely exploded. The side of the truck had been blown off. And I was left wondering, man, I wonder what insurance actually covers when you wreck a U-Haul truck. A lot of you guys have looked at 2020. It's kind of been the same way. We were cruising along on the interstate, and all of a sudden the tire exploded with coronavirus, and you're probably sick and tired of hearing about it. You clicked on this webinar because what we're sharing are what are some ways that you can start taking back control of your financial future. How do we change the tire, get back on the road, and start moving forward? But before we do, let's share a little bit of stuff to make the lawyers happy with that. So we've got to make sure that we're covering with you that the information I'm sharing with you today is purely that. It's information to help you out with looking at options to improve your financial future. I don't know you necessarily, you're not a client of ours, but this is going to give you some actionable items that you can look at to take into account whether you're working with us or someone like us. And there's going to be an opportunity to take advantage of that time later today. So if you're looking for how can you actually take back control of your financial future, that's exactly what we're going to be going over. So what does that look like when you're actually taking back control of your financial future? For a lot of people, right now it's just, how do I get back to normal? Restaurants are starting to open up. Maybe you're out and about. You're actually doing some of your own grocery shopping versus having somebody do it for you. But today we're going to look at actionable items, not for doing normal work on that side. How do you get back to a normal financial life? And what can we do to take advantage of that? So if I look at your plan, for a lot of people right now, you're kind of looking like this. You're feeling a lot of uncertainty. You're unsure exactly what to do. If that's you, you're sitting there right now, you're wondering what to do, and you said, you know what, I don't even need to watch the rest of this. I know I need somebody to help me out. What you can do is click the link to the side of your page, so it's just over to the right-hand side of your page, which would be this way. Click over there. It's going to take you to a link for a calendar. You can actually go on, schedule a 15-minute conversation, and we can see, is there something that you have direct questions about that we can assist you with? As we're doing that and we're going through, you're going to find that a lot of the meat of today's presentation is going to go over some of those things that you probably have questions on. And on the screen, like I said, to the side, you've got that 15-minute link so that you can schedule that time. We've absolutely been flooded with individuals that are calling for advice over the past several weeks, and that's what we're here to do, is help you out with providing some answers. So as you see that on the side, just simply click that, grab one of those 15-minute phone consultations. What's going to happen during that call? It's completely up to you. As soon as you click on the icon, you're going to immediately get access directly to our calendar and see all the available 15-minute slots. And at that time, we're simply going to give you a call at the number you provide. You can let us know what's on your mind, whether you're concerned about the recent market losses or protecting what you have left, or you've recently lost employment. Maybe you've been laid off or furloughed and you have questions about what to do with your 401k. Whatever your concerns might be, we'd love to help you and address your concerns. And that time is simply yours to use however you'd like. If you feel a more in-depth meeting with us would be beneficial, we can certainly set one up at the conclusion of that phone call. But we offer these as a service to the Orlando community to hopefully help put some of your concerns to rest. So again, we'll put this back up a little later, but if you'd like to set a time to speak with us, feel free, click on the icon before the end of our session today. Similarly, if you have comments or questions as we go along over the next 20 minutes or so, feel free to type them in the chat feature, and that'll actually go directly to me, and I can respond to those. I'm happy to address as many questions as I can. Don't worry, I'm the only one that can see your questions, so you don't have to be bashful. Feel free to share with that. Alrighty, so let's take a look where we're headed over the next 20 minutes or so. We have 3 main points on today's agenda. First, we want to take a look at where we are right now, financially, as a country, and how we got here. Second, none of us have a crystal ball. We want to take a second and look at where things could go from here, based upon some key indicators. And finally, and most importantly, in my opinion, we want to look at what each of you can be doing right now to help take back complete control of your financial future, no matter what happens in the days ahead. I don't know about you, but it seems many people have grown pretty darn tired of things feeling out of their control. So whether it's being confined to your living room, You kept your jobs and told where you can shop. People have grown increasingly done with being told what to do. So I'm excited to share with you some things you can be doing right now to grab the reins back when it comes to your financial situation. So where are we right now, financially speaking, and how did we get here? Without getting too far into the weeds, I think it's important that we look at what happened. We'll just call it a Cliff Notes version with this. So the Cliff Notes approach, how we got here, is basically December 8th, 2019, a resident of Wuhan City, China, was found to have symptoms of an unknown virus. So where is that? If you have a globe at home, you can spin it around and look at Wuhan. It's the largest, it's the capital city, largest city of the Hubei province in the People's Republic of China. The population there is a little over 11 million people, so it's packed within it. The virus can spread quickly. Fast forward from December 8th to March 9th, and we find the impact of the virus actually here domestically in the U.S. So while even looking at this calendar may feel like forever ago, it was actually just 7 weeks ago that this all really began here in the U.S. And with investors starting to get worried about the impact of COVID-19, the stock market crash of 2020 began March 9th, which was a Monday. I remember it very well, with the history's largest point plunge for the Dow Jones Industrial Average up to that date. On March 11th, the World Health Organization, the WHO, officially deemed COVID-19 a global pandemic. And then what did the market do? It reacted. It experienced two more record-setting drops on March 12th and then March 16th. In fact, Monday, March 16th, that marked the single fastest drop in Dow history, with it falling 2,997 points, or 13%, all in one day. Over the course of just 22 days of trading, the S&P 500 fell 30%. To put in perspective, a retiree with $1 million invested for retirement, had they been invested directly in the S&P 500, they would have been down to $700,000 in just over 3 weeks. Hundreds of thousands of dollars that likely took years, if not decades, to accumulate would have been gone in less than a month. So while market corrections or declines of 10% or more are certainly common, market crashes of 30% or more are a little less common. And we've never seen one happen as quickly as we did in March. If we look at this graphic showing the data from Bank of America Securities, we can see that the second, third, and fourth quickest 30% drops on Wall Street all occurred during the Great Depression era. That was 1934, 31, and 29 respectively, when the Dow actually plunged a total of 89%. Okay, so with that snapshot of how we got here, what else are we seeing? We don't have to look too far, right? We've all had plenty of time to see a lot. Whether you're opening up your email, turning on the TV, or scrolling through your phone, every headline for the past 7 weeks has been about some type of impact this virus is having on our economy. And while we're certainly wise not to trust everything the media puts out there are a few variables that serve as good barometers of things right now. The first is the staggering number of people who have lost their jobs in this crisis. As of April 23rd, 2020, real unemployment rates are now over 20%, with over 26.5 million Americans losing their jobs. So 20% unemployment, consider that for just a second. That's 1 in every 5 work-eligible Americans without a job. And that statistic has other ramifications, because those people grow unable to make mortgage payments, pay on small business loans, and the taxing that it takes on the banking and lending industries. And for us here in the Orlando area, I know this when I drive down I-Drive, other industries are taking major hits. Many hotels, for example, have all but shut down. Lobbies looking a lot like this one, totally empty, shuttered, nobody there. The estimated toll on the hospitality industry alone has been estimated at roughly $1.4 billion a week. So even the proposed $50 billion bailout for U.S. airlines is not anticipated to come anywhere close to covering their lost revenue, as thousands of planes, they just sit idly at gates everywhere. There's nowhere to fly to if there's nobody on the plane. Overall, a recent Reuters article reported that global airlines estimate their 2020 revenue losses to exceed $250 billion. The retail industry, as I start getting notifications about the Millennium Mall reopening, Simon Properties, retail industry has been incredibly hard hit, with hundreds of thousands of merchants closed for business. In the U.S. alone, our retail industry is normally responsible for contributing roughly $2.6 trillion, or about 25% of the annual GDP, the gross domestic product, a number that will obviously be far behind as the curve finally flattens. So knowing where we are and how we got here, the second question is, where can we go from here, financially speaking? This is a question we've been fielding a lot lately, and it's really no wonder this is on everybody's minds. The reality is, if you asked 5 people right now what the market's going to do, you're going to get 5 different answers. Because the truth is, nobody really knows what's going to happen. And frankly, anybody telling you they do should seem a little bit suspicious. So rather than give you some best guesses, or pretend I have some psychic powers, let's just look at the facts. First, on top of everything else we have that's going on right now, we're in an election year. What does that actually mean to you? Well, there's something called a volatility index, or the VIX. And that's a real-time market index that represents the market's expectation for 30 days looking forward with volatility. So as you can see here, since the year 2000, the VIX has been noticeably higher in election years than non-election years. So even if we hadn't had a global pandemic, market crash, record-breaking unemployment, and major impacts to most and every major industry around the globe, we already anticipated a higher volatility in the market this year. And I wouldn't be surprised to see that volatility actually continue. The second indicator to look at is actually another date on the calendar, March 27th. Anybody know what happened on that date? If you do, go ahead and drop it in the comments. Well, that was actually the day the historic CARES Act was signed by President Trump. It put $2.2 trillion of stimulus money into the economy. And while there's been some debate on exactly how those funds are being doled out, here's what's not up to debate. Those funds were essentially an emergency loan from the government. So with the U.S. already having $24.2 trillion of national debt, that's a 24 with 12 zeros behind it, by the way. We just tacked on another $2.2 trillion. That can generally only mean one thing. Taxes will have to rise at some point in the future, and all of us are going to have to pay up to cover what was borrowed. While this may not have immediate implications for you, it's something we'll return to here in a few minutes. So the third indicator to keep an eye on is unemployment. Unemployment, it's anticipated to continue growing from its current level of about 20% to as high as potentially 32%, or 47 million Americans without jobs. That's from a recent Forbes article. That's 7% higher than this country experienced during the Great Depression. 47 million people, that's roughly equivalent to all the residents in New York, Florida, and Colorado combined. The fourth indicator to consider is the possibility of a recession. Nobody likes the R word, right? Generally speaking, a recession has been thought of as a significant decline in general economic activity, typically recognized as 2 consecutive quarters of economic decline. However, when the National Bureau of Economic Research, those are the people that actually officially declare a recession, says the 2 consecutive quarters of decline in real GDP are not how it's actually defined anymore. So the definition they decided to change. They now define a recession as a significant decline in economic activity spread across the economy, lasting more than a few months. Normally visible in real GDP, real income, employment, industrial production, wholesale and retail sales. So given the fact that they changed the definition, we're already almost there. The final indicator to keep an eye on is what typically happens to interest rates during a recession. When an economy enters recession, demand for liquidity or access to people's money increases, but the actual supply of credit available from lenders decreases. And that often results in an increase to interest rates. So therefore, it's likely we see us rise out of the historically low interest rate environment that we've been in for some time now. So in summary, while none of us can predict the future with absolute certainty, we can, with high probability, anticipate that we'll see continued volatility in the market. We can expect taxes to rise as the government needs paid back for what it offered in stimulus money. It's not free money. Many people think unemployment could continue to rise another 5 to 12%. We're already teetering on a recession. Recessions, those normally result in interest rate hikes. Rosy picture, right? Exactly what everybody's looking for. So let's look at our third and final question, the one that matters most. And that is, what can you do right now to help take back complete control of your financial future, no matter what happens? In a time which so much feels outside of your control, the reality is that your finances and the retirement you've spent a lifetime preparing for don't have to be. Those things actually can be completely controlled. So as we think about these next ideas, I'd like you to consider a question. In fact, I'll even ask you to respond here in a second. The question is this: in times of crisis or emergency, do you consider yourself the kind of person who tends to freeze, panic, just let things happen to you? Or are you more the type to step aside, gather yourself for a minute, formulate a plan, and take action? I ask the question because in times of crisis, those are the primary ways to react, right? Fight or flight. And in a time like we're currently experiencing, many people are obviously worried about making the wrong move. But the truth of the matter is, for many people, the wrong move may be simply to do nothing. So if you look to the side, there's a poll actually right now. And you can click on one of the two with that, and you can say, would you rather freeze or take action? So with that, I'm happy to share the results when we have a conversation as far as which one won with that. With everything that's going on and everything everyone's being fed by the media, which I think we'd all agree we can no longer really trust, you can either sit at home frozen, waiting for things to happen, or you can decide you've had enough of that, and you can plant your heels and make things happen. So let's spend our final 10 minutes together talking about the 3 concrete actions you can take right now, not only to help protect your financial future, but actually take advantage of the current circumstances. Because believe it or not, the current environment actually creates some key opportunities that you should be thinking about. The first concrete step you can be taking right now is to determine your continued exposure or risk in the market. So we've already discussed that continued volatility is highly likely throughout the remainder of 2020. Some of you may have even been watching or seeing this already. There have been days in which the market has actually had nice little pickups, and then other days which the market appeared to be doing well and then lost all of its gains before the closing bell. So given this roller coaster, it's important that you know what portion of your retirement assets are still exposed to market loss. So there's a wise investor, Mr. Warren Buffett, that a lot of you probably recognize. For the past 50 years, he's run Berkshire Hathaway, and they actually just had their annual meeting virtually on Sunday. So you can look up the notes with that. But he owns a lot of companies like Geico, Duracell, Hellsberg Diamonds, and Pampered Chef. Warren Buffett's one of the most famous investors alive, and he's currently the 4th wealthiest person in the world, roughly $74 billion in net worth. What does he have to say about losing money in the market? Well, rule number 1, he's been quoted as having 2 primary investment rules. The first one, never lose money. The second rule, never forget number 1. Why does he say that? Because when it comes to your investments, losses hurt more than gains can help, and it takes a lot to recover from a significant loss. Buffett's always understood that if you want to make money, you start by not losing what you already have. You know, in March, when the Dow dropped 13% and the S&P dropped 30% in the weeks that followed, we were steadily on the phone with our clients. And to be clear, we weren't on the phones because we were panicked. And we weren't on the phones because our clients should have been panicked. We were simply reaching out to them to remind them of the plans that we'd put in place for times just like these. Those were some of the best conversations I can remember having. But what was troubling about some of those were hearing things from our clients like, our neighbor just said they were down 27%. Or my sister just called and they haven't even heard from their advisor yet. Times like these are times you should be over-communicated with, not times you should be having to chase somebody for answers. It's exactly why we've been doing market updates once or twice a week. We've been sending out communications to help out with resources, whether it be YouTube, Facebook, in person, as much as we can, because this is a time when the greatest gift that you can have is clarity. If you're looking at your accounts and trying to determine on your own exactly where you stand, or even exactly how much you still have at risk, I want you to listen very closely to what I'm about to say. Because one of the most misunderstood aspects of investing is, what does it actually take to recover from a loss that you incur? And in talking with people every week, many of them are surprised to see how much exposure they actually have in the market. So let's take a look at why that actually matters so much. Let's say that you had an even $1 million. And in the market you lost 50%. You'd be down to $500,000, right? That's math we can all handle. And many people simply think, well, if I had a 50% loss, I obviously need a 50% gain, and I'll get back exactly to where I started. Unfortunately, that's not how math actually works. And this is one of the most commonly misunderstood things about the market. You see the market is down 10% one day, and then the next day it's up 10%. Are we back to even? Well, the answer is no. So if we were down 50% to 500,000 and then we have a 50% gain, where do we wind up? I'm only back to 750,000. I'm still 25% short of where I began. In reality, in order to recover from a 50% loss, you need a 100% gain. So that's why Warren Buffett and investors like that feel so strongly about avoiding losses, because losses hurt much more than gains can help. So for those of you that just experienced a 30% loss in the market, you don't actually need a 30% gain to offset or recover from it. You need 42.9%. And how likely is that to happen? Particularly when we anticipate continued volatility for the foreseeable future. So the first concrete action you can take to put yourself in a better position is to find out exactly how much risk you're still taking. Again, it's not all uncommon for us to meet with folks who are either in retirement or within a few years of retiring, who still have 60 to 75% of their assets exposed to the market. What would Uncle Warren say about that? Well, he actually does have something to say about it. He's famous for having said, when it comes to the market, you never know who's swimming naked until the tide goes out. In other words, many people don't realize just how exposed they are on Wall Street until it's too late. He also recently said, it's insane to risk what you have for something you don't need. In other words, the fourth wealthiest man on the planet isn't a big fan of taking excess risk, particularly when it's not required to reach your end goal. So what does that really mean to you? It means you can live the life you've desired in retirement right now without having to take significant market risk to hopefully accumulate more. You likely should. Now, folks, I understand this flies in the face of some traditional wisdom you may have heard from brokers spout for decades. They're known for saying things like, just ride it out, stay the course, it'll all come back. The problem here is there is no course to stay because we've never actually seen this combination of events before. There's never been a global pandemic anywhere near this magnitude impacting the U.S. and global markets to this extent, with skyrocketing unemployment during an election year. You know, it's like somebody rolled the dice and we're in Jumanji. It's everything that could go wrong all at once. So I don't mean this to sound testy, but anybody giving blanket advice to just sit tight right now seems highly aloof to what's really going on. And if you don't absolutely need to be taking risks to get where you're going, for many, according to Buffett, that kind of exposure doesn't make much sense. So if you'd like to receive a complimentary risk analysis, that from our firm, you can just click the icon on your screen. We'll keep this up for a moment here, but you can just click the icon. Like I said, it's to the right-hand side of your screen if you're watching on your computer, or it's down below if you're watching on mobile, and you'll get direct access to my calendar and set up an initial 15-minute phone consult. And we're just going to have a conversation, absolutely no cost to this for you. And frankly, if you've never had this done for you, this can be one of the most reassuring things you can do. Now, some of you may be asking yourself, what even is a risk analysis? It sounds like something from NASA, right? Is this going to be 200 pages of stuff I can't even understand? The answer to that is no. A risk analysis is quick. It's a simple review of your retirement portfolio to determine what portion of your assets are at risk in the market and what risk you have of not reaching your desired goals for retirement. What this does is, in a few simple pages, it gives you an at-a-glance clarity around where you stand financially and what risk adjustments you might need to make. What this ultimately means to you, though, is that you have, for some of you, you could, for the first time in your lives, have definitive answers as to whether your goals are within reach. And right now, with so much feeling uncertain, that kind of certainty is invaluable. I highly encourage you to take us up on this, as many people probably wish they'd had access to this information years ago. So I'll leave this up for a minute. You can see it to the side, but don't miss getting a free risk analysis to see where you stand. This is something to really help out with doing that. So as you click forward, if you have questions about this, you can just put it in the chat section. Again, only I can view those, so I'm happy to help out. But I can see some people that are taking advantage of that. Fantastic. All right, George. Yeah. Okay, Alice, I see that you've clicked there as well. Fantastic. Cherie. Okay, I see you're all scheduling times. That's awesome. Fantastic. I look forward to talking to each of you soon. This is going to help you out. I really feel like this is going to help you out with that. So be sure to check on that. So we'll go ahead and continue. Second action that you can take right now to better protect and prepare yourself is to minimize the taxes that you're going to be paying in the future. I know. None of us even like to think about them, right? We're happy that they changed the tax filing deadline because that means we can think about it later and we didn't have to get it done by April 15th. But the incredibly important thing to consider, if you're not interested in handing the IRS more than necessary, and you'd like to leave as much as possible to your kids or charity, if you're not really concerned about any of those things, feel free to ignore the next 2 to 3 minutes. But for the bulk of you, this next piece could be very important. So just about any time I bring up taxes with new clients, they often say, well, I've got a CPA. We've been using him for years, and many on this webinar likely do too. I'm actually not one, but we work closely with them ourselves, and they're incredible. The only danger just comes, and listen closely here, the danger comes in assuming that all CPAs are doing tax planning. So the reality is some accountants don't function as tax planners, but they just do tax preparing. In other words, it's kind of like this guy here on the screen. He's a historian. Think about what we contact them for. We file our tax returns, right? In other words, they work primarily in the rear view mirror, determining which taxes we've already paid and which we might be able to get back. That's not tax planning. That's tax retrieving. That would be a little like calling a coroner a doctor. They're two radically different roles. So now we've already talked about the tax environment we're in and what we anticipate happening, but let's just take a look for a second and give you individual feedback. Given what you know right now about us being in a historically low tax environment, and the government having just issued over $2 trillion in stimulus money to stimulate the economy, what do you think? Do you think taxes are going to be going up or down in the future? Again, you can just click to the side with that. There's a quick poll for you to vote. Do you think taxes are going up or down? All right, fantastic. I see some of you guys are responding with that. So great. So you're all with me. We all agree that taxes are likely going to go up. So given that, again, back to the idea of sitting back and waiting for something to happen to you versus creating a plan and taking action, what could you do right now? Well, let's see. Let's see what we should be maybe taking advantage of right now. As some of you see these words on the screen, they're old hat to you. But for others of you, that may be a little foggy. And you have heard these terms, but yet you're not really 100% sure what they mean. So let me make these really simple. A traditional IRA or individual retirement account allows you to put pre-tax dollars in. So those dollars you put in, you haven't paid tax on them yet, they can grow. You don't pay tax on them while they're growing. It doesn't mean you pay no taxes. You're going to pay taxes when you start taking the withdrawals. So normally people do that once they're 59 and a half or older. And people traditionally, they love IRAs because those contributions up to a certain limit, they're tax deductible. It's like you've made less money this year because you went ahead and put money over here to save. And the power of those the traditional IRAs, the tax deferral allows gains to compound on themselves. So hopefully it builds a nice little nest egg over time. Roth IRAs, on the other hand, those are funded with money you've already paid tax on. And those contributions, they're not tax deductible. But because you've already paid your taxes up front, you don't have to pay them later on when you take the distributions in retirement. So while these two types of IRAs have been around for years, they commonly get confused. One of the easiest ways to think about them is a simple analogy of a farmer. Farmers have to pay taxes just like everybody else. But if you were a farmer and you had a choice, which would you prefer? Would you rather pay taxes on the seed you put in the ground or on the harvest that seed ultimately became? Because at the end of the day, that's really the difference between a Roth IRA and a traditional IRA. A Roth IRA is equivalent of paying taxes up front or on the seed and never being taxed again. A traditional IRA is the equivalent of paying taxes later on the harvest, when there's no telling just how wild your fields might go. Fortunately, the IRS allows something some of you may have heard of. It's called a Roth IRA conversion. Now, a Roth IRA conversion is simply transfer of your retirement assets from a traditional IRA into a Roth IRA. What you do is you just pay the taxes due at the time that you convert the money, and then it allows all your future growth and distributions to continue on tax-free. Much like traditional IRAs and Roth IRA conversions have been around for a good while. In fact, some of you may have actually entertained one previously, because if you were pretty certain taxes were going to go up in the future, which we all are now, it can often make great sense to simply bite the bullet and pay those taxes now rather than waiting for them to climb and facing them in the future. Roth conversions have always been something to consider, but right now, they may even be more attractive for many of you. Here's why. Let's think of this spring here for a second as your traditional IRA account balance. Let's just say you had $100,000 in it prior to the market crash in early March. At a 24% tax bracket, a Roth conversion would have cost you $24,000. But if that same account were now down 30% due to the market losses, that same Roth conversion would only cost you $16,800. It's because, in essence, your account value has been compressed. So this is one of those rare opportunities that you only get every now and then when you can be in the know. It can help you take an otherwise negative situation and leverage it for some positives in it. And remember, once that conversion is complete, you will never pay another dime on any withdrawals from your Roth IRA ever again. So if you'd like to see exactly what you could save on converting a traditional IRA while account values are compressed and taxes are effectively on sale, it's as simple as hopping on our calendar. So again, you can simply click to the side. There's the icon there on the right-hand side of the page if you're on the computer. It's down below if you're on mobile. And you can simply click that. It'll give a 15-minute conversation so that we can have a chance to answer any questions you might have, address any concerns you've been wrestling with, and then we'll be able to ask you for a few numbers to be able to conduct the Roth conversion review. This takes very little time, and we can be back in touch within a day to let you know 3 things. First, we'll let you know what a conversion would cost in terms of taxes. Second, we'll let you know how advantageous it would be now compared to your account values prior to the recent market decline, so you can get a sense of what it might cost should your account rebound to its pre-COVID-19 levels. And third, if you'd like our help actually completing the conversion, we'll let you know exactly what you need to do to complete it. To get that done for you, again, at absolutely no cost or obligation, simply click the icon on the right-hand side of the page if you're on desktop, down below if you're on mobile. For anybody that has questions on that, let me know. Fantastic. All right, Mike, I can see you raising your hand to do that. Awesome. All right, Bob, Alice, okay, great. All right, fantastic. So again, I appreciate that, guys, with shooting me the note so that I can see who's taking advantage of that. We're going to be happy to help you out through that Roth conversion. The third final action step you should be taking right now to take back control of your financial future is to help ensure your financial foundation is secure. I don't know that there is anything we could be talking about that's more important for most of our clients than this. So be sure you're listening these next 2 or 3 minutes. So for years now, when clients have walked in our doors, we've visited with them about the different parts of their physical or financial house. So it's just like building their physical houses, right? When you build a physical house, it's absolutely critical that we get one thing straight and solid. Yeah, the foundation. Several of you guys on this webinar may have built a home before. And as far as the excitement goes, unless you start just like staring at concrete, foundations are about as boring as they come. Uh, they're just several walls of cement poured several feet deep into the ground, reinforced with rebar, metal. They're not that exciting, but they're absolutely critical because without them, nothing else can be built, right? Or at least nothing that'll last. For those fancy granite countertops we all love or the amazing master bath we could build, those things don't matter much if the foundation caves in. The same is true of the foundation in your retirement. In retirement, the equivalent of your boring foundation is your income. For 30 or 40 years, the vast majority of you have been receiving a regular paycheck, maybe once a week, every 2 weeks, or once a month. But once you enter retirement, the responsibility of manufacturing the paycheck, well, that falls primarily on you. And when it comes to your paycheck in retirement, the last thing most people are looking for is excitement. Instead, they simply want consistency and predictability. So once you're in retirement, nobody wants to find a crack in their plan. This could show up in a number of different ways. It could look like a significant loss in the market that might impact the amount you have to create retirement income. Or it could look like paychecks that simply don't keep pace with inflation over time. Or it could even look like a stroke or a significant health event that requires you to tap into a big portion of your assets and completely derail the plan. But the bottom line is generally the same. You get one shot at retirement, and nobody wants a big surprise as it relates to their income. So let's pause here and ask a question. If you've been working with an advisor for a while now, has he or she provided you a written retirement income plan? So I've got a survey to the side again. You can just click yes or no. Yes, they've provided you this, or no, they haven't. And some of you may be thinking back to your last annual review with your advisor, or the statements you get, and faithfully file away. And to be clear, something like this is not a plan. And frankly, if you feel like you need an interpreter to understand it, well, that's not really a plan either. Think about the plans many families establish with their kids in case there's ever a fire in the house. Do those plans require someone from NASA and a computer to understand? No. We want this to be one-page simple, easy to read. Of course, right? That makes sense. You're going to go out through this hallway, and if that's not an option, you're going to go out through this window, and we're all going to meet at the end of the driveway. Plans are meant to be simple and understandable because that's how you need them when you're in a moment of crisis, right? You need it to be simple so you can understand. A true retirement income plan, in just a few concise pages, simple English, it should answer these 5 questions. Number 1, it should tell you exactly when the paychecks you create for yourself in retirement will begin and which pocket of money you'll be tapping into. Second, it should tell you in what order you'll tap into those pockets or buckets of money because that is very important. Third, a good retirement income plan won't just stay static because your life is going to change. The cost of goods doesn't stay static, right? It changes. A gallon of milk today versus a gallon of milk 20 years from now is going to be very different. Fourth, it should have built-in provisions for what should happen if you or your spouse, or maybe someone you care for, should become incapacitated or need long-term health care. And finally, this is perhaps the greatest question we can help you address. It should mathematically show you exactly how long your money will last. You should have a probability of success knowing, is my money going to last regardless of what happens with market crashes or global pandemics? Now, if you're sitting there saying to yourself, if this kind of thing is possible, why don't I have it already? Why haven't I ever fully understood my plan or had this kind of reassurance? If that's you, I have 2 pieces of encouragement as we wrap up today. Number 1, it's not your fault. You're not alone. Believe it or not, a majority of those we first visit with, week in and week out, have been working with a financial advisor for years without ever having a true written retirement income plan. We see it. So don't think for a second you're the odd one out. This is common. And second, like I said, it's not your fault. And I want you to hear that loud and clear, because here's what I know. I know that at some point in most people's lives, not knowing exactly how investing and planning for retirement works, they made a brave and bold decision. You likely did it too. They picked up the phone and they called somebody to help them. And if they did at some point, and hear me here, I want to commend you because you took action. And you likely would not be where you are today if you hadn't. The fact that no one has created a written retirement income plan for you, that's not your fault. The truth of the matter is you did your part, And candidly, several advisors just don't really specialize in this part of the game. It doesn't mean they're bad advisors. Many of them are great at helping you to accumulate money up to retirement. And they may do a wonderful job of that. It's just, if we really look at it, you've got to find someone that specializes in helping you get through retirement. At the Life Wealth Group, we think that's really important. Because of that, our third and final action item for you today is to get a written retirement income plan. This is something I'm offering to everybody that's on this call today that's able to see this here online. This plan does all 5 things we've covered in a few short pages, and best of all, it's easy to read. Layman's terms. It's things that you can easily understand at all times. What does that really mean to you? It means you can finally put many of your biggest concerns to bed. Do I really have enough? Can I go ahead and retire now versus going back to work? Because we'll have tested that mathematically for you, and you can be assured in writing exactly how long your money will last and exactly how your plan will work. Folks, there's plenty of other things to put your mind on right now. Your money does not have to be one of them. So if you'd like to have this kind of clarity, again, just click that icon on your screen. It's over to the right-hand side if you're on desktop, down below if you're on mobile, and that's going to be a link for you to schedule a 15-minute phone call just to have a consultation, see what questions you have and what we can potentially help you out with. And if you're concerned about what that 15 minutes is going to cover, here's what it won't be. It's not going to be somebody sitting on the other end of the line trying to pitch you something. Maybe you've had that experience before. Instead, it's simply us asking a few questions and listening, hearing what concerns you most, and determining how we might serve you best. As we mentioned, you can request that free risk analysis to see what portion of your nest egg is at risk of further losses. We can complete a Roth conversion review to show you what you could save in taxes, and we can start your retirement income plan for you. All of these are absolutely free. And frankly, we just think they're important for you to have done, regardless of what comes next. So click on that icon, grab a time that works for you, and we'll give you a call at that time. When we're doing this, this is an important step for a lot of folks. So if you're in for that, just drop me a comment in the side, put I'm in. You can put the best number to reach you, or you can click online so that we can help you out with scheduling that. Looks like I can see some of you guys that are clicking through right now. All right, Barry, I see that. Okay, fantastic. Thanks, Ron. All right, Jeremy. All right, guys. So then in the meantime, here's some homework for you. Go do something fun. Connect with your family. We're starting to see the economy open back up here locally. Safely distance yourself. Relax. Try to have some fun. Find that one movie or show you haven't already watched, right? Or if you haven't already binge watched everything on Netflix, how about this? Just turn off the TV and head outside. Grab something to drink. Take a deep breath. Enjoy all the little things that we've likely all taken for granted. I know I have. And just remember this. There are better days ahead. Before we know it, we're going to be cooking out with friends over the 4th of July. At some point, we're going to be back. The ballparks are going to be open again. The Rolling Stones will be back on their next farewell concert tour. And everything's going to be okay. I hope you'll find the time today to unwind, wherever that might be for you. And to remember this simple fact. You're absolutely undefeated in facing the challenges life has thrown your way. And you will make it through this one too. I appreciate you having the time to be able to spend with us as we go through. But as we continue to look at this and coming out of COVID-19, whether it's from us or someone like us, we'd love to help you in any way we can. So as we close today, I'm just going to keep this link to the side for you. And in case you need to look at a calendar to see what time works best for you, over the next few days, it'll pause on the page for you to schedule a time with us. But please do that. Now is no time to be worrying about finances when you can be in control. So I leave you with, as we go through, making sure that for you and your family, stay safe, wash your hands, and don't hog the toilet paper. We look forward to talking to you soon.